Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello, everybody. My name is Minh, and I'm your co-host with Rob from NDIS Property Australia. And you used to do the SDA Housing Podcast. I show explains, highlights, guides, and brings awareness about all things SDA in this ever-changing NDIS world. Rob, Happy New Year. How are you?
Yeah, Happy New Year, Minh, and everybody. All good. Just getting back into it now, and we're discussing what may happen this year with a few topics like interest rates and the Australian dollar and how that can affect property.
Indeed.
So it's pretty interesting to talk about that.
So, Rob, last year, it was pretty much around 65, 66, 67 cents for most of the year. Then all of a sudden, in December 2024, or if not early January last week, it's hit 60, as low as 61-ish cents. I want to ask you, our resident economics expert here, unqualified, obviously.
Yep. Just a personal interest. I'm happy to talk to everyone about.
A hobbyist. What's going on with the AUD, please?
Okay, the first thing to look at with the AUD is it's predominantly being driven by what's happening with the US dollar. The Australian dollar is not doing too badly against other currencies, but it's obviously devaluing against the US. And it really comes down to the fact that Trump's been elected. Now, over time, the US dollar's been getting stronger and stronger around the world, but with the election of Trump, the short-term reaction to that was that the US dollar's got even stronger again, which has then caused the Australian dollar to go down. And the reason why the Aussie dollar is going down as well is that we're heavily tied to China for exports, iron ore, as everyone would know. And Trump's talking about bringing in tariffs on imported goods from countries such as China, which will then affect their economy potentially negatively, which then people are saying, okay, well, that's going to affect Australia negatively as well, and they may not buy all the iron ore, which then causes the Australian dollar to go down. So that's the initial reason. Going forward, though, there is a few different things that could happen that could either cause the dollar to go down way further. Now, I remember when it was down at 49 US cents back in the late 90s. So that's a big drop from here, but that is one potential outcome. It could also reverse shortly and start to go up, which we can discuss what might be the causes of that as well.
So, Rob, let's just step back a little bit. You said, as Australia is a mostly a commodities-based country that exports a lot of commodities to China, who use the resources to build product and sell product overseas to countries like America. If Trump imposes tariffs, which causes less supply from China, which causes less demand from Australia's supply, which affects our Aussie dollar being weaker. Okay, noted. And that's because of Trump being so bullish on his ability to run a business called the American economy. That's one big factor, true. What other factors are causing downward pressure on the Aussie dollar other than the whole China and tariffs topic? Is there any more, or that's it?
Well, I think that's the main one. But it isn't just happening to the Australian dollar. It's happening to just pretty much every currency around the world versus the US dollar. And people can look this up, but there's a theory in relation to the US dollar called the dollar milkshake theory, which basically means that everyone around the world needs US dollars because there's huge debt in the world and it's all denominated in US dollars. Therefore, there's demand for US dollars going forward is always going to be greater than the supply, which causes it to get stronger and stronger versus other currencies. And that's been playing out really for the last few years.
Gotcha. Hold that thought. History. Let's go back in history, Rob. Why was the US dollar pegged as the world currency? It has to do with oil, obviously. That's the first question. My second question is, what's all this talk about moving away from the US dollar by BRICS, Brazil, Russia, India, China, other organizations trying to get away from the US dollar? Give us a bit of history content, please.
Yeah, well, as people would know, the reason why the US dollar became the world currency is that after World War I and World War II, that the US was on the right side of that. They set up throughout the Middle East where they pretty much controlled the oil fields in partnership with Saudi Arabia and the United Arab Emirates and Iran and Iraq. So everything became based on oil, and oil was priced in US dollars, which then drove trade around the world, which has pretty much been the case for the last 70 years. And the US has protected that through, as you know, the use of the United States military, which is the number one backer of the US dollar and keeps it being used all around the world. Now, as you mentioned, the other countries like China, Russia, Iran, a few others around the world are trying to reduce their dependency on US dollars, but it's pretty hard because they have a lot of holdings in US treasuries and need the dollars for that.
I remember years ago, the Chinese yuan, people were trying to break away somewhere, trying to make that more of a liquid currency. This talk of alternative currency, Rob, is that because of the Team BRICS, or is it some group individually, other groups of countries?
No, it's mainly China and Russia that are driving it, and it's a geopolitical issue that they want to reduce the reliance on the US dollar, because that then makes the US the most powerful economy in the world, and the other two, China and Russia, obviously would like to be the biggest economy in the world.
So moving on to other topics. The Russian war, America supporting Ukraine, Trump coming in to say he'll stop the war very quickly. How does that factor, the geopolitical topic on that topic, affect the US economy and the US dollar again?
Yeah. Okay. So the bigger picture, let's look at what Trump's saying that he wants to do and what effect that will have. The biggest problem the US has got is that their level of debt is through the roof, both government debt and private debt, and they have to be able to fund the interest on that debt.
How much debt? 3 trillion or so, or more?
Oh no, the US government, it's 35 trillion, going on 38 trillion, and the amount of debt in the US completely, including private debt, credit cards, household mortgages, everything is 100 trillion. It's humongous and getting out of control.
So, other than printing more cash as a as a unsustainable system, what's the solution here with regards to the USD? You say it's the biggest currency, it's strongest currency, everything's being pegged against the USD. So, what's the solution moving forwards? What's the outcome here?
Okay, well, you mentioned the big advantage the US has got, and Australia have got this too, and China, is that the US has got the ability to print more money, which most countries around the world haven't. So in order to fund their deficits, there's only a few ways that you can do it. You can either print more money, or you can start to pay down debt, or you can default on that debt. They're the three options. And historically, and this is going right back to Roman times, as everyone would know, what all governments end up defaulting to is printing more money, because that's the most palatable solution for them to get re-elected. It's the only one that people will accept over time. So the US is going to continue to print more money, and that's probably going to ramp up again this year. We can talk about how the money supply in the US and Australia affects interest rates and then affects property prices, etc. It's all interrelated to do with printing money.
So if there's a run on print of notes in the US to create more currency, how does that affect the US dollar?
Yeah, okay, so let's look at what Trump wants to do. And there's a couple of things here that are going to cause the dollar to go in different ways. One, he's talking about putting tariffs on countries. And I think that a lot of that is more just him using that as a negotiation tactic and threatening the foreign countries to get what they want. But maybe he will put some on. Now, if he does that, that's going to cause issues with the US dollar. And then it also is going to lead to more inflation in the US, because if he puts a tax on imported goods, those imported goods go into America, which causes prices to go up. That's one option. The other thing that he's talking about doing with Elon Musk and the Department of Government Efficiency, DOGE, is that they're looking to slash what they're spending in the US government. Elon Musk is talking about getting rid of $1 trillion worth of spending. If they do that, that's going to cause issues in the US and cause the dollar to go up again. Now, what people need to understand is Trump's ultimate goal here from now when he gets into power, he'll want the dollar to weaken, right? He doesn't want a strong US dollar because he's been elected under the premise that he's going to bring industry back to the US, which will create more jobs, which is what got him elected. His supporter base is traditional Americans who have lost their jobs or are looking for some sort of security in terms of their future employment.
Blue-collar workers.
Yeah. So if he's going to bring back industry in America, which he's talking about, whether it's the car industry or all sorts of industry and get it out of Mexico and China, the only way that's going to work is if the US dollar goes down and it then becomes more profitable and competitive to build this stuff in the US. So his ultimate goal will be to bring the US dollar down, which should eventually help the Australian dollar and make the Australian dollar go up, if that makes sense.
Yeah, it does. First question to you, do you think it'll hit 60 cents?
I think probably it's near the bottom now, actually. I think it could bottom just after he comes into power, which is in the next 2 weeks. And then it may start to go up because if you look at the last time he became president in 2016-17, the dollar was doing the same thing. It was really strong right up until the point that he was inaugurated. And then it turned and started to weaken for the next couple of years after that. I suspect that's what he'll want to have happen this time as well.
Sure. So we're at the bottom here, as you say, 61, 62 cents. Probably flow between 62, 65 the next year or so. With the weak Aussie dollar, will the RBA in Australia be more keen, more proactive in cutting rates to stimulate the economy?
Well, not necessarily, because if the Australian dollar gets weaker, that means what we import gets dearer, right? Because the Australian dollar is worth less. So when we import cars and I think it's currently about 15% of all goods in Australia are imported. A weaker Australian dollar means prices of those goods will go up, which means it could be inflationary in Australia. And if it does cause inflation, the RBA is going to be less inclined to reduce interest rates because they want to put a hold on inflation. But the flip side to that is that the other thing that Trump is really keen on doing, and he actually talked about it overnight again, is he wants a weaker US dollar, but he also wants interest rates in America to be slashed way more. And the Federal Reserve has already started reducing interest rates. So the likelihood is they're going to continue doing that into the new year. And if US interest rates go down, that puts more pressure on the Australian RBA eventually to start to reduce interest rates here as well. Because if we always follow the US, it takes 6 to 12 months, but we tend to use them as the guide for everything.
Gotcha. So if the rates, which were cut back in November, which we saw nothing drop in Australia back then, by the way. Do you still hold firm what you said last 2 episodes ago, where you think March, April, we were seeing the first rate cut in 2025?
Well, it's a bit of an unknown question, isn't it? You can never be sure, but sure. I think rates probably will come down at some stage this year, but the RBA is being pretty stubborn currently in saying that they're not going to reduce them, but that can flip pretty quickly.
Yes, but if Trump is going to be aggressively wanting to see interest rates cut down in the US, as you say, we're going to follow suit at some point, right? So as stubborn as the RBA is in Australia, they're going to have to follow suit eventually when the US is cutting down, and Australia will have to follow through.
Yeah. So it really depends on what happens with the Australian economy. And this is another topic, but I think you'll agree it's not doing too well, is it? Everyone we talk about just being out in the general public, people are generally not doing as well as what maybe they were 5 or 10 years ago. You go to the supermarket and just about every time you go, it feels like everything's going through the roof in price, which is obviously the reason why they haven't cut rates. But if everything that happens reduces the Australian economy and reduces exports because of tariffs in China, as we discussed, then unemployment's going to go up even more in Australia. Then the RBA is going to have to reduce interest rates to stimulate the economy. Now, whether that happens this year, because the other thing with this is that most of these state governments and the federal government of Australia have now got a lot of debt based on what they've been doing over the last few years. They've got to pay off that debt as well. And if interest rates remain high, the government debt percentage that they have to pay on the debt levels is huge. So they're going to want interest rates to go down as well, the same as what's happening in America. Otherwise, they won't be able to afford it to pay the debt. So the likelihood is interest rates will go down, the money supply will ramp up, and liquidity will be increased both in the US and Australia this year to stimulate the economy. And that theoretically is a good thing for the outlook for property prices, because property prices in Australia and the US and pretty much all around the world over the last 30 years have got a very high correlation with the money supply. When the money supply goes up, that ends up in the price of property. And when it decreases, as what's happened over the last 6 to 12 months, property prices stall or even go down, which is what's happened in Sydney and Melbourne. The property prices in Australia, I think, and I've researched this a lot over the last 10 or 15 years, the number one driver of property prices is the money supply, which is the amount of new money that's created in Australia, and whether it's through mortgage debt or the government. Obviously, the more money there is, property is a scarce, limited resource. People bid the price of what they can get for that money up. And conversely, when the money supply reduces, that causes the price of property to go down, which pretty much has happened in correlation for the last 30 years. So if as we suspect, they will print money in both America and reduce interest rates here, that's going to stimulate the money supply, which should help property prices this year going forward for all types of property.
Let me clarify that point again. You said it'd be better for the property economy, property market. The property market's done well already the last 2 years. What do you think will happen with property investors' appetites, the investor appetite for property, given the correlated relationship between AUD and interest rates? That's my question.
Yeah, well, the issue obviously is if interest rates stay high, it is, as you know, difficult for people to be able to get the loans and afford the property based on serviceability and the actual dollar value, which has made it difficult, particularly in the SDA space. But if interest rates drop, then that's obviously going to help, and more people are going to come back and look to invest in that sector and property in general. So I think right now it's a little bit difficult. Like in Melbourne, for instance, in Victoria, it's tough at the minute. But that's more local issues to do with the Victorian government and taxes and people wondering whether it's good investment. But I think that'll turn again in the new year and things might start to improve.
Yeah, I agree. So obviously, two big factors in Australia at the moment we're looking at is really the commodity prices, the iron ore, natural resources going to China. Second big factor is the Olympics in Brisbane in the next 7 years or so, which is going to cause movement or migration of labourers and workers to certain areas to look for jobs as well. Lending interest rates there, interest rate being so high at the moment that we all want to see the rates drop down, I guess, this new year. And that will obviously bring the type of investors back in the marketplace. We'll see people more borrowing capacity for home borrowers, first home buyers to buy their own, build their own house. One. Number two, we'll see more investors overall hitting the property market because it's cheaper to borrow money. It's more easier to borrow because of lower rates for the RBA interest rate cuts, obviously. And in turn, I think we'll see the quiet period of SDA investors coming in again in 12 to 18 months' time. That's what I think. Okay, because
I think you're right.
Up until now, it's been too hard for investors to get borrowing approved, to borrow money from the bank. The lower the interest rate cost is to borrow money, the easier it is to get, cash flow positive return. The whole goal of investing in property has always been capital growth and or income, cash flow positive. And I think that we'll see the quiet period of SDA, which is basically going to be 12 months, end of March year 24 to end of 25, we'll definitely see an uptake of more SDA property investors back in the market in a year from now, I think, yeah. But
that'll give it time to reset and become more, less supply, more demand, become easy to get tenants. So it's just a cycle.
As everything in life, everything's a balance and imbalance, it's cycle. As you said so many times in the past as well. Bonds, gold, cash, interest rates, property, it's always a cycle, up and down. And people got to really be conscious of the long-term impact of these factors, the economic factors being government risk, market risk, currency risk, all those different risks that we were aware of, obviously, in the economic world. that impacts upon everything we do here, and our job security, our borrowing capacity, inflation costs, cost of living, all that has I guess, an impact upon our investment returns. And it should be important to everyone, Rob, because we all have superannuation, mandatory superannuation, SGC, and our superannuation funds get impacted upon the world economy and also local currency as well, local economic returns. Speaking of which, Rob, I know we're going off topic here, but do you see the next 12 months, 24 months as uncertain or certainty, given the way things are overall around the world?
In terms of investments and returns, or?
Just everything. Not investments, just world economic climate, which obviously impacts upon economic investment returns, yes. But how do you see the next 12 months overall?
Yeah,
12 months, 24 months.
I'm very bullish and very positive on what's going to happen now with Trump in the US. He's basically an entrepreneur. So he's going to do everything possible to make people better off. Mightn't be the right result in the long run. In 2 or 3 years' time, it might cause more problems. But in the next 12 months, it's going to be like a sugar hit around the world. And I think that we're in for a very good time over the next 12 months in pretty much everything.
I agree. I mean, he's always served one presidency term already as a president. So he's not going to have a re-election anymore. This is his 4-year term. That's it. You know, he's going to make it with it.
Yeah, and he's got a big ego, as you know. So he's been talking a big game. So he's going to want to back it up, and he's going to do everything possible to back it up with jobs, lower interest rates, more money, and more wealth around the world, which will impact on Australia and be the same here.
Rob, how do you see the Australian property market, the general property market going the next year?
Yeah, no, I think it'll go up as well, particularly maybe more in the secondary locations, but I think Melbourne will turn around and improve again as well. So I don't see any property crashes. I don't think interest rates are likely to go up, put it that way. That's the least likely scenario. They may stay where they are, but the likelihood is that they'll probably drop a little bit, but they're definitely, I wouldn't think, going to increase unless something comes out of left field that we don't really know. It's like increase, right? That would really harm the property industry in Australia, which is what everything runs on.
But interest rates have been high for the last 2 years now, bro. And
they're stubbornly high.
The property market's still gone strong, even with the high interest rates. And there's obviously an impact upon COVID, migration, jobs, lockdowns. If the US is going to be aggressively slashing interest rates, surely Australia will be seeing a lot more interest rate cuts than just 1 or 2, surely.
Well, we'll have to wait and see. But no, I don't think we'll have as many cuts as the US. I think rates will go down quicker there than what they will here. Our government now, RBA, is pretty conservative, remember?
Yeah.
And they're going to be reactionary. They're only going to cut rates aggressively if things start to go wrong, which we don't want either, right? We don't want the economy to go really bad and unemployment to go up, because then people lose their jobs.
So what's the average interest rate now going to be? It's around 6.5, I think, average.
Yeah, to 7, I think. Yep.
I think 6.5 is an average on a home loan, a variable rate interest rate, right? I reckon if we see probably 2 or 3 cuts over the next year and a half, long term, we'll be seeing the average rate being around below 6.0. That's where, as you say, if it was aggressive, as we would love to be, but it's not going to be. We'll see the 5s, but probably 2 cuts, 2, 3, 6.0. Yeah, that's where I think we'll see.
Yeah, maybe a fraction more, but But then I think it'll be reasonably short-lived. They'll go up again in 2 or 3 years' time.
Really, Rob?
Because inflation, because that big, bad, ugly inflation will come back. If they print more money in America and Australia, eventually inflation will increase again, similar as to what happened after the pandemic.
Gotcha.
But we've probably got a couple of good years.
I reckon 2, 3 years, yeah. Rob, I reckon one of our next topics you and I should talk about on our podcast here is flipping. We've never spoken about the word flipping before in SDA, but I do see people doing flipping of SDA accidentally, successfully, if you know what I mean. No one goes in SDA with the intent of selling after a year or 2. No one does that. But I am seeing it.
Yeah, when they've got the tenants in, right?
Yeah.
They can get a higher price.
But the flipping process is pretty big. the return. It really is. And I've been watching that. I've been watching that sector for that part of the sector for the last 4 years now. And I had a theory behind it, but I'm seeing more and more of it happen. So I do want to talk about this topic later on. Given the uncertainty of interest rate cuts and increases or whatnot, given the uncertainty of the property market, there is still niches in the property market, in SDA specifically, where people can gain profit. You got to do it right. Yeah. Anyway, that's a different topic. Rob, thank you so much for today's interest rate, Aussie dollar discussion. I think it has a big impact upon where we sit in the property market, being SDA as a sector. And this will be one of many topics that people should consider and review as part of their long-term strategy in SDA investing. Any final words of advice, Rob, before we hang up?
Not really, other than as we discussed at the start, we're just a couple of guys with a bit of knowledge on this stuff, but we're by no means absolute experts on it. And I don't think anyone is, to tell you the truth. So people have different opinions, and we'll just have to see how it turns out.
Indeed. Rob, thanks so much for your time, mate. Appreciate it.
No worries.
Bye-bye.
Bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.